And our speaker today is Paul Tudor Jones II, the prominent investment manager, conservationist, and philanthropist. Paul is co-chairman, chief investment officer, and the controlling principal of Tudor Investment Corporation, which he formed in 1980. Tudor is part of the Tudor Group, affiliated companies engaged in trading across global fixed income, equity, currency, and commodity markets for an international client base. And Paul is a portfolio manager focusing on discretionary macro trading and is the principal risk taker for Tudor's flagship client strategy. And Paul is also well known for his tireless efforts as a conservationist and philanthropist. He is co-founder and a board member of the Everglades Foundation, committed to protection and restoration of the Everglades through science, advocacy, and education. And since its founding in 1993, the Everglades Foundation has worked to bring people together, to provide a powerful voice at the state and national levels. And Paul is a board member of the Robin Hood Foundation, which partners with more than 200 organizations to fight poverty in New York City. And he is chairman of the Just Capital Foundation, a former chairman and current board member of the National Fish and Wildlife Foundation. And Paul is also a director of our favorite organization, the Palm Beach Civic Association. And Paul's been a member since 2016. And now I give you Chairman Pucillo and Mr. Paul Tudor Jones II.
Thank you, Mary. Can you hear us okay? Yes, sir. All right, okay. First of all, Paul, thank you very much for being here today in our second of our signature series. We very, very much appreciate it. I'm going to start with trying to give the audience a little sense of what you do. You've been described as a macro trader. You describe yourself as a, quote, technical trader who reads the tape. And you also say that that's now becoming a lost art form. So tell us a little bit about what those terms mean and what that translates to for you.
Well, a macro trader, the easiest way to describe that is to look at what most people are used to doing, which is investing in stocks, whether it's through your 401k or IRA. I don't really trade individual stocks. A macro trader is kind of a prehistoric throwback. I don't trade individual stocks. I trade baskets of stocks. So I'll trade the S&P 500. I'll trade the Nikkei 225 in Japan, Eurostoxx 50 in Europe, and then I'm trading basically large asset classes. There are 4 of them. There's stocks, which I trade most all of them globally. There's bond markets, obviously, the US bond market, the European bond market, UK, Japan, China. So I'll trade bond markets and debt instruments and different tenors within those bond markets, whether it's something within 1 or 2 years all the way up to 30 years. Then the third thing that a macro trader does is trade foreign exchange relationships. So I'll trade the relationship between the euro and the US dollar, sterling and the US dollar, Australia and the US dollar, the yuan and the US dollar. And then finally, where I cut my teeth was actually trading commodities back in 1976. So that's the 4th asset class. And when someone says macro, it's because you're trading all these global relationships. And the reason why technical analysis as opposed to fundamental analysis is so critical in macro, critical in everything, is that technical analysis basically looks at the open, high, low, close of every single day, of every single instrument. And the one thing that I learned really early on, particularly back in 76, 77, when there wasn't the internet, there wasn't this deluge of information, and I'm sitting there literally reading the printout from, at that point in time, a Reuters feed, because there were no computers at that. Boy, it dates myself. I feel like Back to the Future, and I'm talking about the DeLorean, right? When you talk about 76, good gosh. Anyway, so you're reading that, and there's such a paucity of information. The only way that you could really make a decision a lot of times was looking at price charts. And the great news about price charts are they never lie, right? You get paid depending upon where that instrument closes that day. So I've seen many, many people who confuse being right fundamentally with making money. And you can be right fundamentally and absolutely lose your shirt and go bankrupt. I've seen that many times. So I don't think you can trade macro. All the really great directional macro traders are people who you look at the chart and it's real simple. If something's pointing that way, you're long it, and if something's pointing that way, you're short it. And I know that's an oversimplification of the process, but critical to any kind of longevity in it.
Okay. You've also said that to be a good trader, you need to be a contrarian. And
No, I'm not.
you're not a contrarian.
No.
Okay. Well, one example I can think of is, and I mentioned we would talk about this, the 1987 October crash. The markets were on a straight tear going up, and many of us in this room remember that Black Monday where the stock market declined 20% in one day. Dow was down about 22 points, the S&P 500 about 20. You saw that coming and had the conviction to take positions short that took advantage of that. Tell us how that happened. How were you able to see that coming when everyone else saw nothing but a raging bull market?
Well, it was really interesting because, again, I started out in '76 trading futures. And futures, you're trading on 4%, 5% margins, so your leverage is 20 to 1. And then particularly in the '70s, we had inflation. It was the greatest, most volatile period that I can remember in my entire career. And when I started out, I was literally seeing grains, stuff was doubling and cutting in half in the space of 6 months. So that was a great and a bad lesson at the same time. It taught me never to trust ownership of anything. We're all products of our environment. Why am I a macro trader? When I went to look for a job in '76, equity markets we had been in a bear market for 4 years. Rates were punitive. Equity markets were shunned. When I was getting out of college, I thought, I can go into stocks, but I don't know what my career would be in the stock market, but I know what my career would be in the commodity market because people had to eat. And that was literally what my thought process was. People will always have to eat. I'll always have a job. There'll always be something that's moving. And you won't be dealing with desultory markets like we were at that point in time in equities. So I started out in futures, and futures taught me never to trust ownership. It was actually the worst thing that could have happened to me if I looked back retrospectively, because that was the best time to go in the equity markets, because the fact if you were predisposed to ownership of something and wanting to keep something and not always seeing gray clouds everywhere, then obviously we've had the greatest bull run of all time. And yet I grew up in a period, again, my first 6 years all the way to 1982, good gosh, equities were just a bad term, a bad word. 1982, we started financial futures. That's when the first futures contract on an equity market began trading the S&P 500, the New York Stock Exchange Index. And all of a sudden now you could buy stocks, basically 20 to 1 leverage. And that went on till we got to 1987. 1987, the market was really overvalued. You had rates over 6.5%. And so it was as overvalued as, more overvalued actually on a relative basis. If you just look at, for instance, the earnings yield minus the dividend yield. But there had been over that 5 years this massive, massive move towards using futures. They were becoming a lot more. They actually became the price discovery mechanism rather than individual stocks themselves. And that's the way every futures market that's ever existed works. It actually becomes the focal point of liquidity. Anyway, in 1987, someone came up with this bright idea called insurance, portfolio insurance, where they thought, because we'd been in bull markets forever, that you could have a strategy where if the market started going down, you could start hedging, and they started selling these products that essentially was like selling a massive out-of-the-money put on the stock market. But options at that point in time had only been trading a couple of years, and so the discovery and the understanding around options was also very limited. And since I started out in futures, I really understood derivatives, and I saw what was going on in all these portfolio insurance that people were buying. And it was really clear to me that once the market started to break, there was no way the liquidity was there to be able to execute all the programs that were going to be enacted. It was one of those deals where, as the market went down, it actually accelerated the selling, and there were no limits. And so, the one thing about trading commodities starting out is they learned 50 years ago that you can have a lynching in any instrument. You can have a lynching in that instrument. The market can do that because everyone just fear takes over, and the fear hits this apogee. And same thing with greed and excitement in the upside. It can go to some incredible point. And that's why in the commodities markets, they had limits every day. Well, we'll move X amount and then we'll close the market. Or we'll just stop trading unless people want to enact at that amount. So they had a break, a rest period. It makes a lot of sense. Well, the financial futures markets thought, we don't need that. We're adults here. We don't need to have that type of limitation. And that's why when that thing broke on that day, again, just because I understood the derivatives markets, because I'd seen so many insane bear markets. I'd already had all the reps, in commodities in particular. I'd already had the reps. And I'd been through the late 70s and early 80s. And remember, we took interest rates to 22%, 21% and back to under 10 in the space of 6 months. So I understood that volatility. I knew it could happen. So that wasn't any great call. That was just having domain expertise when other people did.
Well, interesting. I want to sort of move to markets generally. You've talked about some times in the markets when inflation was very high, interest rates, as you indicated, early 80s went into the 20s. We've just gone through a period where we've had very significant, fast increases by the Fed in interest rates. And I remember you gave a little talk in October where you indicated you were concerned interest rates were still high. Since that time, it appears inflation is coming down. Employment still is pretty good. It looks like maybe we're headed towards that soft landing and not experiencing a recession. Are you surprised at the extent to which inflation has come down in a relatively orderly fashion, and maybe heading towards a soft landing, maybe not?
Well, inflation's coming down like the Mike Pence for President posters did in Iowa, right? It's dropping. It's dropping really fast, and I fully anticipate the Fed starts cutting in March. You got to realize the stock market is it's not, I would not say it's necessarily reflective of fundamentals per se. Stock market is just a reflection of all of our ideas of what value is, the same way some people want to pay hundreds of millions of dollars for a Picasso. So right now the stock market's is being boosted by AI as it should be. It's dragging everything up. If you look at the S&P 493, it's kind of unchanged, but you've got the Mag 7, which is driving everything through the roof. So what happens to the stock market in the next 12 to 24 months has a huge amount to do with what the policy response is by whoever our next president is to the fiscal situation that we have in the United States. So you've got really divergent paths for the stock market. I think if you said to me, where do I think the stock market will be 5 years from now or 10 years from now, I think it's quite possible that it's here or lower. And I'll unpack that in a moment, but it's also possible that, listen, now I sound like a lawyer. It's also possible it can be much higher. Again, it depends on what kind of policy responses that we have next year when the new administration comes in.
So you mentioned AI. Right now, it's obviously you indicated you think it's affecting the market, but is it also affecting fundamentals, boosting productivity, doing things like that?
Hugely important.
Yeah.
Hugely important. So there was a Fed paper in 2000. Every 1% increase in productivity is probably worth 30 to 50 basis points off of inflation. And it also, you could see it add somewhere between 1 to 2% in GDP growth. So it's hugely important. And there are going to be a lot of, and that's actually, if you had to pick the silver lining that gets us out of the fiscal mess we're in, it could be AI. AI could be, that could be the knight on the horse that rides in and saves us. I'm a little concerned about AI in, well, two ways. One, and this would be another whole topic, but I don't know if you all saw that they surveyed 2,758 AI experts, and they asked them, what is the chance that do you think that there's a 5% chance that AI could end humanity? And 58% of them said yes. So you got to think, wow, the people who are the closest to this think there's a 1 in 20 shot that it could wipe out all of us here. And so, man, you got to think, how do I, like if I'm Congress, if I'm Chuck Schumer, who's leading up this panel, we're actually having an AI conference in New York. Robinhood is sponsoring one where we're giving out, we've got $3 million prizes in various poverty-fighting silos to who can come up with an AI solution on workforce, on education, et cetera. And he's going to be at that. I can't wait to ask him, how do you risk manage a 5% chance of the end of humanity? How do you, I don't know.
No futures contracts for that.
Yeah, you're right. Yeah, you'd be short all those futures, right? So anyway, and why is it that AI is moving unbridled at the pace? One, because there is so much money in it, and I would say that, and two, it is going to have massive benefits. And so, but again, you've got this benefit cost, right? You've got the tail event. I was reading, there's a great book, and it says it'd be very simple with AI now in a couple of years for one bad actor to go create a pathogen that would be resistant to almost anything that could kill 1 billion people. That's really scary, right? And I just read that last night, thought, oh, wow, that's wonderful, wonderful bedtime reading. But, you know, that's how powerful a neural net is in terms of its computational capability and what it can do. So, yeah, it'll be really interesting to see. My guess is that it'll be one of those deals where it'll take an accident before something happens. That's the scary part of it.
Yeah. hopefully not too bad an accident. You mentioned debt and the fiscal outlook, and I know that this is an issue that you've spoken about and feel very strongly about. And just to frame the issue, our debt now is about 120% or so of GDP.
125.
125, okay. There doesn't seem to be any indication that anyone's addressing the issue. Tell us your concerns with respect to where we are now with regard to this debt situation in our country.
So if I ask you what do you think the fiscal deficit is today?
Well, if it's 100 and...
No. What do you think our deficit spending is for calendar 2024? I'm not trying to call anybody out. I'm just curious.
Well, we haven't had balanced budgets in 25 years, so it's got to be multiples of what it was earlier.
It's 7.5%. 7.5%. Think about that. 7.5%. So next year we have, I don't know if y'all remember, but Trump enacted tax cuts. Brilliant man, enacted tax cuts with 4% unemployment because we're going to grow our way out of this. And of course, in 2019, before COVID, we had, under Trump, a 4.8% budget deficit. And again, these numbers from the macro world are just critically important. I remember back in 92, 93, when Europe was on the verge of creating the European Union, they had this treaty called Maastricht. And Maastricht, the absolute no-go zone, the absolute no-fly zone, the red boundary was 3%. That was the outer boundary, and everyone had to manage inside it. So anyway, with the Trump tax cuts that he enacted, they expire in 2025. So that will mean everyone's tax rate here in this room will go from 37% back to 39.5%. So that gets you about $350 billion in savings. So when the Trump tax cuts expire and all our taxes go up, just a little under 10%, that only leaves us with another trillion that we have to find to be able to stabilize our debt to GDP at 125%. So at 125%, we're clocking in number 4 behind Japan, Italy, and Greece. And we're 125. When the Trump tax cuts expire, assuming they expire next year, he'll try to do everything he can to ignore that. When they expire, that'll still leave us with, wait for it, a budget deficit of 5.5%. And if you just look at the CBO projections, 2030 we'll have a budget deficit with the Trump tax cuts expired of 8%, and then 2050 we'll have a budget deficit annually of 10%. So, one of my first professors at the University of Virginia was Herbert Stein, and he said, if something can't go on forever, it stops. And so that the situation we're in is not sustainable. And the question is when does it manifest itself in the marketplace? When does this la-la land? We wonder why our stock market is where it is. We wonder why the dollar is as strong as it is. We have, if you look at the U.S. relative to the rest of the world, we are the largest and most egregious fiscal aggressors that there are. So my guess is sometime this year, which will be second only to 2 years ago, in the private markets, we're going to bring, the U.S. Treasury is going to bring to market $2.8 trillion worth of debt, $2.8 trillion. So we did that in 2021 with no problem, but the Fed was buying. Securities did, which kicked off the inflationary bout that obviously we've experienced and been fighting as short-term rates have gone to 5.5%. So the question is, we're going to have $2.8 trillion worth of buyers of U.S. debt. They're going to be looking at all of us in this room. And the big question is will the market tolerate it? And will it tolerate in particular if we look out and see nothing but larger debt to GDP? If right now, CBO projections is the debt to GDP in the United States without some drastic measures will be about 250% in 2050. I would argue well before then we'll have lost our reserve currency status, and we would have, more likely than that, we'd clearly have a debt default. I don't think anyone would fund that. So we know we're going to have a reckoning, and the question is, what does that reckoning look like? I will say, again, the white knight, which could allow us to kick it down the road, is the productivity boom that you referenced. That could actually offset all the increase in debt to GDP in the next 7 years. We saw something, you had 3 big productivity miracles, say, in the last century. You had in the 50s when we were rebuilding our infrastructure in the US coming out of the war. We had in the 80s with the introduction of the personal computer. We had in the 90s with the internet. Inflation dropped in all instances. That's actually, you had a really inflationary boom post-45, and it was that productivity miracle that actually brought inflation down while we had interest rates fixed at 2.5%. So it could have been, and that's why debt to GDP came down so much, because we were growing at 5 and 6% with interest rates fixed at 2.5%. And inflation actually wasn't going up, it was coming down because productivity offset so much of it. So that could be our great white knight. I'm a little concerned when I try to think about productivity being our great savior. I look at Elon Musk right now, and he's wow, what a incredibly nuanced individual he is. So I don't know if many of you have seen, he wants 25% of Tesla. That's what he wants, to continue leading Tesla. He wants 25. He just got finished selling down $50 billion. Well, he wants the company to give that back if he's going to continue to put all his intellectual resources into it, robotics and a variety of other things. So that's the trick with the productivity miracle is, okay, if we get 1.5% of GDP, who's it go to? What do you do? There'll be huge displacement in white-collar jobs. It's estimated you could lose 30% of knowledge workers, accountants, lawyers, doctors, a variety of knowledge workers. So how do we distribute that productivity miracle? Well, Elon, and give him credit, right? He's probably maybe one of the most greatest human contributors since Einstein. But here's a guy who looks 1,000 years in the future with space travel, but his governance goes actually back 1,000 years ago. It's very tribal, right? It's all for me. You work for me. You do what I tell you. It's all for me. So how productivity miracles distribute is going to be one of the biggest social challenges that we deal with as a country. He wants to take his net worth from $250 billion to $500 billion, and it's going to be at the expense of millions of knowledge workers in the United States. And so that's a real challenge. For anybody with any kind of wealth, he's the poster child for a wealth tax. He's the poster child for the French Revolution, if I'm being honest. I mean, God forbid. A better way, if you said what could actually fly, a suggestion would be, and now I'm going to put my just capital hat on, a suggestion would be, why not, okay, if this contribution, if your understanding of AI, robotics, and a variety of things is that great, why not do an ESOP, employee stock ownership program for Tesla? Why not let everyone that's involved in that, as well as attract a variety of outside talent? Why not do it where you're capped at 5 or 10% of that ESOP? Why not share that wealth in a way that's not going to further increase the wealth gap in this country, further increase the divisiveness in this country? I'm rambling now, but one of the most interesting—
I'm going to bring you back, don't worry.
One of the most interesting statistics is that a country's social harmony is a direct reflection of the wealth gap between the top 10% and the bottom 20. It's just, you can go look across, you can look back through history, you can look horizontally right now. How people feel about society in general is a function of the relative wealth within that society. We've, as a country, our poverty levels are so much lower than they were 20 years ago. It doesn't make any difference because, like it or not, human nature is as much about the relative game as it is the absolute game. And when you've got a group of people sitting at the top, they are perceived to be entitled, and it creates social disharmony. That's why if you look for the happiest countries, they're typically ones where the income skews. It's called a Gini coefficient. It's not as skewed as it is in the United States, and we're one of the most skewed in the world. So how we distribute the productivity gains is going to be another social challenge for this country. Big challenge.
Well, you mentioned productivity as possibly one savior to this debt situation. There have been a number that have been kicked around in the media by politicians. From what you've said, I'm gathering that you probably don't believe in the notion of just grow our way out of it by cutting taxes.
It's like being at a Christmas party and you'll say, I'm just going to have one shot of tequila. Just one. It just doesn't happen, right? History's not really friendly to that idea. So, no, that's just complete bullshit. I mean, we've seen it time and time and time again, my God. And it won't happen this time. That's what Trump will try to do if he's elected. Remember, this guy is, you got to realize, this guy's a real estate developer who loves debt. The problem is we're probably at a tipping point. And that's why I'm really nervous about this year, because I think the bond markets will revolt if he's elected. I think they'll just absolutely revolt. What he'll do, and this is why, see, it's really interesting. So we've got to find 4 or 5 to stabilize, not to reduce debt to GDP, but to stabilize debt to GDP. We've got to find somewhere around 4%, 5% of GDP, somewhere around, assume the Trump tax cuts expire, you still got to find $1 trillion. So how do you close that gap?
Well, it sounds like taxes is one way to do it.
Well, it's going to be a combination of reducing spending, where you probably find $300 billion, or increasing taxes, where you find $700 billion. So just a menu of what it takes for us not to increase our debt to GDP. A menu would be, I'm just going to get in. There's a great on the internet, you can go and you can sit there and you can play with it yourself, turn all the dials to figure out how you go and close it. But here's a menu. You increase the corporate tax rate from 21 to 25%. You increase the payroll tax 1%, and then you, right now it's capped at $160,000 per person. You take the cap off. You increase Social Security from 65 to 70. You means test all Social Security benefits for the top 50%, and means test Medicare also for the top 10 to 20%. And that does a really good job. And then, you let the Trump tax cuts expire, and that gets you about, also, in addition to that, you have a carbon tax. I think that gets you about $50 billion. You also implement a carbon tax. And then that still leaves you about 350 billion short. And to close the final 350, you can do one of three things or some combination. You can increase the top marginal tax rate on the super wealthy to 70%. You can increase the top marginal tax rate on anyone earning over $180,000 to 50%. Or you can have a wealth tax for anyone over $50 million of 2% and over $1 billion of 3% annually. And all those measures together, obviously reducing, increasing Social Security, all those things together will stabilize debt at 125% of GDP, the fourth worst in the world out. And remember, that means we've got more debt to GDP than Argentina or Mexico or Australia or Turkey or Iran or Iraq or China. So yeah, it's a daunting set of metrics. And it's not complete doom and gloom because we are the center of the AI revolution. There is a productivity miracle coming. It's amazing. I asked our CTO at Tudor, I said, what do you think in software engineering, what do you think our productivity increase will be in the coming year? And he told me 25%. 25% because we can use AI. Our coders can use AI to go ahead and write code that they used to have to do manually. And then, can I just ask a question? Anyone here, you have to raise your hand if you do it. How many people here use either ChatGPT, Bard, or Perplexity AI? Raise your hand. So that's about, I'd say, half the group. Certainly within 12 months, the entire group will be using it. And the more you use it, the more you recognize how much more efficient you are at everything you do. So I can sit there and just, even in preparing for this, what we're doing in our company and on the research and analysis side, it's just amazing, the efficiency gains that come with it.
Well, in describing the menu of potential options to deal with the fiscal situation, you talked about significant changes in Social Security, Medicare, tax structure. You hit about 3/3 rails of American politics when you said that.
Yes.
So, which I'm guessing are probably not likely to be enacted under any administration. So let's hope we do get that productivity boost.
Well, it'll be, so the way that our political, the way everything works is, right, it'll go until it doesn't. So there'll have to be an action. If you kind of rewind to 2008, when Lehman went under and the financial system was completely broken, it took Congress passed an $800 billion TARP bill to bail out most of corporate America. And then at the last moment, the Republicans nixed it. We can't be, this is socialism, blah, blah, blah. And the stock market went, oh, really? Pow! And we're getting ready to have it run the banks, and they passed it about 3 days later. So my guess is what will happen is that sometime this year, we'll have, sometime in the coming, there's going to be an accident. It'll be in the bond market first. There'll be an accident in the bond market, and that's going to get everyone's attention, is that. And it won't necessarily be in front-end rates. It'll be really interesting because you'll see the Fed cutting rates because we're in a disinflationary period. And then, but you'll see coupons, tenors of 10 years and 30 years out. You'll see those long-term buyers just kind of give up, I think. So it'll be really interesting. What you have to do when you're thinking about your portfolio, you have to watch what the response is, right? There's really two ways that this can go. One is, and the historical way that it's gone in many countries is we have austerity. Think about Greece in 2010. Now, Greece was different because it was part of the European Union, and they forced on Greece measures that literally made those countries, made those people just cry. Then you have a situation in Argentina, right, where there's no one to force them to do anything. And so their recklessness has led to this inflationary spiral until they just threw out this president. They put in this new guy with these radical. He's going to enforce austerity is essentially what's going to happen. So there's two ways to go, and they have really different consequences for the markets. You can go the austerity route, and that's going to be raising taxes. Then you can just stop and think about it. Wow, what's that going to do to GDP? GDP gets slammed. What's that going to do to earnings? Earnings get slammed. What's that going to do to the stock market? The stock market's going to get crushed. That's one way. In the long run, that's probably the best way. It's short-term pain, long-term gain, to go stabilize, to actually live within your means and keep everything where we have longevity for those wonderful kids sitting there in the front row. That's probably the best way to go. The path of least resistance, which will happen probably if Trump's elected, is he will stick to the, we're going to grow our way out. He will really come down hard on Jay Powell. Remember, Jay Powell under Biden's had a pass, right? He raised interest rates 500 basis points in the shortest amount of time that any Fed chairman's done. And Joe Biden didn't say a word. Joe Biden has done what presidents should do with the Federal Reserve Board and leave him alone. So what'll most likely happen is Trump will come in. Just as a side note, so the Fed last year, for the first time in its history, lost $115 billion. Lost $115 billion. It typically in the last 5 years has been remitting $75 billion to the Treasury. So that's a $200 billion swing, which has to be financed. That's part of the $2.8 trillion that had to be. It's going to have to be financed by the Treasury. Why did it lose $115 billion? Because to fight inflation, he raised interest rates to 5.5%. They had this portfolio that they had accumulated during COVID that got absolutely annihilated. And they also have, within the banking system, they're paying reserves that banks hold at the Fed for their capital base. They're paying reserves at 5.5% when they have a portfolio of debt that's earning 3.5%. So they got a negative 200 basis point spread, which is why they lost $115 billion. Anyway, the reason I bring it up is because Trump will come in and he'll say, look, these problems we've got, this problem in the bond market, it's because the rates are too high. This Fed, these guys are going to kill us. We can grow our way out of this, so let's cut rates. And I will promise you the Fed's already, though they haven't said it and they will deny it, they're already. I'll bet you Jay Powell's already looking ahead and going, oh my God, this guy's coming back. Wow. So he will be under so much pressure to cut. And that's one reason why the stock market's rallying, right? It's looking ahead and going, okay, we're going to get a lot of rate cuts. That's good, and that's good, right? It's going to stop. It's going to stop. Here's an interesting statistic. Every meeting that the Fed delays cutting 25 basis point cost Americans an extra $25 billion in the deficit 1 year forward. So if he stays abnormally tight to fight inflation, that cost us $70 a person in this room extra if he stays too tight. So clearly he has an incentive to cut rates. And that'll be good for the stock market. Donald Trump will get in and will hammer him into cutting rates, probably to the point where it's very possible that much like 1975, 1976, when we had this disinflationary pulse from the oil embargo of 73, and then the Fed started cutting rates under Arthur Burns, and they cut rates too far, too fast, and then we had that massive inflationary upside resumption in the late 70s. If you said to me, what do I think's going to happen If Donald Trump gets in, even if he doesn't, I think that what will happen is there'll be so much pressure on the Federal Reserve Board to cut rates that there's a good chance and if you kind of go back for 2,000 years, the history of indebted countries or empires is you inflate your way out. You inflate your way out of your debt problem. So my kind of base case is we're going to see inflation resume sometime next year. We'll always run interest rates too loose. It's the only way that you deal. It's the kind of classic way that you deal with an overly indebted country is you inflate your way out. And then the big question here is stocks could do well under that scenario. The last thing that you want to own is any duration fixed income, anything over 5 years. That just right now is so grossly mispriced. That's the absolute last thing that you want to own.
People are going to go out of here and call their brokers.
Well, now stop and think. We're going to get the juice here, and with Donald Trump, we're going to get a lot of juice. Stocks could like it for a period of time. The problem is, the bond market will absolutely be jumping out that window, and at what point in time does that catch up with the stock market? So it's going to be from a macro perspective. The best thing that could happen to me is Donald Trump gets elected, because it's going to be like being at the rodeo and you're on the toughest bull that's ever gone. Whoop, here, the door's open, get ready. And my guess is it'll be something that looks like 1976 to 1980. It'll just be crazier than hell. If Biden gets reelected, something tells me that the markets, and maybe I'm wrong, that the markets will enforce on him, because I think he's weak enough. They'll probably try to go more of the austere route than under Trump. Again, I don't know. That's why I'm saying you have to pay attention to what happens here in the next 12 months, because it'll have a huge impact. Under Trump, you could be long stocks. You want to be long all the inflation assets. You want to be long Bitcoin and gold, and you don't want to have any duration in fixed income. And you want to kind of bet on the resumption of inflation. And if we went the austerity route, you wouldn't want to own stocks. You'd want to own fixed income. You'd want to. I'm not sure the dollar does well under either one of those guys, under either administration. But you wouldn't want to own any of the inflation assets under true austerity. I just don't see how in our electoral system that anybody survives being voted for taking the medicine that we're going to have to take.
Mm-hmm. Yeah. Well, we've talked about debt and some pretty thought-provoking remarks. We haven't even talked about the geopolitical situation. Put on top of everything you've described, the fact that we've got a war in Ukraine that's about to go into its third year, war in the Mideast that appears to be heating up and not cooling down. The stock market doesn't seem to have reacted too much to this. But do you think that's going to continue? And how do you think you put that overlay on everything you've just described? How is that going to play out?
Yeah, it's funny. There's actually a geopolitical risk index that you can track that's been around. It actually goes back to 1900. We're actually really low on the index right now, having spiked in 23 with Russia, Ukraine. Look, the problem with the geopolitical, it's not so much that we have that many more wars or conflicts right now. The problem is the tails associated with them. Every year the technology, the warfare technology gets so much better. And, we just had enter into the dialogue in the Russia-Ukraine, the concept that we'd actually have tactical nukes in a war theater. So it's not so much the amount of conflict, it's just the tails, because our technology is so much better. And so that's way down on my list of things to worry about. I mean, clearly, the other thing is, and the way this geopolitical risk index is calculated is it just looks through newspapers and looks at the headlines and then quantifies it, and then it sits there and measures it against prior years. The problem is that you've got Xi, who's a thug and a dictator. You've got Putin, who's a thug and a dictator, Kim Jong-un. And then you've got this theocracy in Iran. So you've got 4 unhinged and megalomaniacs that all have the capability to create huge problems. And I can't remember, like if you compare and contrast now to, let's go back to 2000. Wow, in 2000 we had democracy and capitalism breaking out everywhere, and you had this basically a geopolitical kumbaya moment. Whereas now we've got very unpredictable people with hugely nationalistic tendencies. And so it's the tail events, really. It's not so much that we have the issues, at least quantitatively we don't, it's just that we know they can, at any moment, explode into something that's much more dire.
Well, I want to have room for a few questions from the audience, so I want to touch quickly on some of your philanthropic endeavors. You talked about Robin Hood, Just Capital, and I want to ask you about the Everglades Foundation as well. These are important things to you. You've been focused on these. You've had some challenges with them. But tell me why these are some of the things that you find very important and why you've been drawn to these type of endeavors.
Well, I was raised in, I think one of the best things going for the United States, the reason why we are today, and it's so funny, I was having lunch with a guy from a really good trader at Deutsche Bank who's an Indian, and we were talking about just geopolitics, and he said, and we were talking about the difference between democracy, Western democracy, which most of them were based on Judeo-Christian principles, India, which is based on Hindu principles, and we're just thinking about, and then you look at China, China really is a country that doesn't have, I guess, Confucianism to a certain extent, doesn't really have a strong set of religious moral standards. And it's a problem, right? It's the reason why Judeo-Christian countries have done so incredibly well, because they embed in their citizenry the difference between right and wrong because it's imparted to them through their religion. So that's really important. To Robin Hood's point, I was raised in a Christian family. I was taught from a very early age Christian principles of love your fellow man, do unto others as you would have them do unto you, help those that are destitute. So that was clearly what motivated me in the early years of Robin Hood. And I would say Robin Hood was really interesting because in fighting poverty, probably by 2010, it was really, for us, the big win was, if I think about private philanthropy, what is it? It's the crucible where you're able to experiment to find the best ways to go and alleviate society's problems, and in particular poverty. That's really what private philanthropy does, and there's so many instances. We were the first ones to fund charter schools back in 1993. There's so many, I can go on and on. There's a litany of things that we've done that then ultimately embed themselves in public policy. So a big win for us is we do something and the city or the state, in the case of Robin Hood in New York, takes it over. We work with all 23 agencies in New York City and virtually all the state agencies. And we always try to embed our intellectual capital, which is much, much more valuable than financial capital. But by 2010, it was really apparent to me, wow, we're really trying to be the pathfinder, the rudder on the governmental aircraft carrier. We're trying to steer it. Same way we are at the Everglades Foundation. We're trying to be the rudder and provide the intellectual capital that we bring from our staff and board there into public policy. the elephant in the room for social change, right? Where we spend, if you think about it, private philanthropy is probably $560 billion. The federal budget's about $5 trillion, so it's 10 times bigger than private philanthropy. The elephant in the room really is the corporate sector, right? The corporate sector's 50 times larger than private philanthropy. So Just Capital was a recognition that, holy cow, if we're gonna fight poverty, where we spend 40% of our waking hours is at work. It's at work. So if we're really gonna fight poverty, if we're gonna fight society's ills, it really has to involve the corporate sector, how we conduct ourselves in businesses, how businesses conduct themselves. So I was really happy when I walked in, because a gentleman walked up to me and he goes, "Hey, I'd like to meet you." I said, "Great." And he goes, "Yeah, Tudor Foundation just gave us a grant this year." And that made me feel so wonderful, because our company, having opened an office in Palm Beach when we got here 7 years, immediately, because of our ethos, tried to integrate into this town and do good things for this town. And so, you're welcome. So my point is, just think about this. Right now, corporations give 1% of their profits to philanthropy, 1%. That works out to be about, let's see, 2.5 trillion, 1%. I guess that's 25 billion. So if they just went to 2% or to even 3%, that 25 billion, that 50 billion, for instance, at Robin Hood, we think that our grant making has an 8-to-1 payoff. 8-to-1 because of the fact we've got 40 smart as hell board members, women and men who really, really are thinking about how do we quality engineer what we're doing. Again, look at the difference in charter school performance versus public education. So the idea to get companies and the intellectual capital that companies have into the game of being positive change agents for social good is really why we started Just Capital. And I would say it's funny, 2019 was probably the best point of our company, and that was when the S&P 500, the Business Roundtable, which is the 500 top CEOs, said, we're going to change the purpose of business. They have a statutory definition which says the purpose of business to that point in time was to manage on behalf of shareholders. And then they changed it to, the purpose of business is to manage on behalf of all stakeholders. And they took our 5 categories, which is employees, customers, shareholders, local communities, and the planet. They said we're going to manage on behalf, they left the planet out, but to manage on behalf of all stakeholders. And that's really, again, that's so important. If the reason our country is at each other's throats so much is because we can't find some commonality on things. And one of the easiest ways to do that is to try to get everybody on the same page, where they're at work and spend 40% of their day.
Well, thank you. Well, we appreciate your coming to the Civic Association today. We're running short on time, and I want to have, Mary, if we have a minute, do we have time for maybe 1 or 2 questions from the audience? Because there have been a lot of thought-provoking comments this morning, and we appreciate your coming and talking to us. And maybe we could just take a couple questions, if that's okay.
All right. Yes, please.
As you pointed out, any rational thinker understands that we need austerity to get out of the situation that we're in, as families do, as businesses do, as nonprofits do, and you're spending more than you're taking in, on top of lumbering with a lot of debt, which is such a wasted opportunity with the hundreds of billions we spend every year, our government spends, that doesn't build roads or parks or schools or anything else. So we need austerity, obviously, and you talked a lot about austerity today, but on the private sector, because raising taxes is a form of austerity. But you really didn't mention the government taking much austerity.
I'm sorry. Included in that just base cases, we had to put a 1% cap on discretionary spending per year, where it's typically 5%. So that included a 1% cap on discretionary spending.
But do you think our government, because AI bringing tons of efficiency to the private sector, 25%, in your own business's case, that means people that won't be working there. Don't you think that productivity gains could help our government run more efficiency with less people, and maybe our government gets out of some of the businesses that it's failing at that could lower our government spending? So we do both, and we lower government spending to actually help solve this problem. Because it seems like our government is passing austerity onto us. Inflation is austerity, for example.
Yeah. So the most heartening conversation that I had in the past couple of years was with Glenn Youngkin, who's the governor of Virginia. And we were talking about what he was doing now that he was governor. And he said, he goes, what I'm trying to do is to try to get a 25% productivity gain and efficiency gain in the state government in Virginia. And he talked about, and he goes, in my first 18 months, I think I'm halfway there already. He goes, we've got the DMV waiting line down from 45 minutes to 13 minutes. He goes, I've called in, Virginia funds a bunch of their state universities. He got called in every president, and we have a meeting now every 6 months, and I've asked them to go over their university budgets with me to see where their expenditures and their revenues are. And they're all looking at me like I'm crazy. What are you talking about, a budget? So the best statement I ever heard was from Mike Bloomberg, who said, I simply want an executive who can make the trains run on time. If we could magically elect anyone, I would elect someone who knows how to value engineer a $5 trillion budget, who actually wants to take the time to go and deal with the minuscule details of governance with every single cabinet head and go through and value engineer. I can tell you that so much of the government doesn't work today. I'm involved in a land exchange in Colorado that has been going on for 23 years. You can't make it up, I swear. I mean, I don't even think Moscow back in its best days of the Soviet Union could match this one. And the deal that we're making for this land exchange is probably a 2-to-1, that's not true. It's probably a 3-to-2 benefit for the public. So we just been over it. I take that back. It probably is a 2-to-1 benefit. But you have non-functioning bureaucracies in the United States right now. And it's because we have a leader who has no idea even how to get dressed today. And then now we're getting ready to put somebody in who's just going to want to talk and feel good and play golf. So it's not necessarily the greatest situation that we're facing. We really need an extraordinary manager is what we desperately need, much more than an ideologue.
Maybe one more. We've got a mic for you there.
Yeah.
If you were asked by the new administration to serve in any capacity for them, would you?
Well, I don't think.
I hope so.
No, it's funny because the one thing that worries me about Trump getting elected is who is he going to get to serve? Look, no person with any kind of chops, it has to be a contest of ideas. We can't have one guy at the top or one woman at the top that just says it's my way or the highway. No. It has to be. If you think about all the progress that mankind has made from the beginning, and the countries and the societies and the areas that do the best, why is the United States number one? We have a contest of ideas. We import through immigration the greatest intellectual talents in the world. It's because we're not afraid to have a contest of ideas and let the best idea win. So anything that short circuits that, and I'm really nervous about Trump because I think the quality of his cabinet, particularly given the fact that, I don't know, it'd be interesting to see what the quit and fire rate was from his first cabinet. I don't know where he gets people of substance that are going to want to go there and work. If somehow you were able to ring fence him from policy, you could, but who would want to work for somebody where all your hard work is for nothing because at 2 o'clock in the morning he throws a fit?
So was that a no answer?
For him, it'd be,
Yes.
again,
And-
it would be.
We've got the chief financial officer.
Right, and
Yeah,
we'll do
anyway,
Larry,
I'm
and then
gonna-
to Jimmy, please. Yeah.
No label.
No label.
The concept of a third-party candidate against two candidates that are not very popular. You have any thoughts on that?
I'm a big fan of no labels. They're having execution problems. Yeah, I think they're having execution problems. It'll be interesting to see what happens. But yeah, of course, I would vote for something other than the alternatives we're facing right now.
And to Jimmy, please.
Thanks for your time today. I'm going to ask a question. In the room, whose insurance has gone up by about 50% in the last 2 years?
Yeah.
Can you comment?
Yeah, I'm going to self-insure.
Well, thanks so much. We really,
I am.
No, on behalf of our members, our directors, my colleagues, our chairman, Michael Pucillo, Paul, we thank you so much for your time. We do have a gift for you. And
You and I are on the board together.